Today we're going to be breaking down apartment takeout financing, the ins and outs of how to prepare once you have your apartment building and are wanting to pursue that takeout financing. What exactly is apartment takeout financing first, and also at what stage during the purchase are we looking to take out financing?
It's kind of like forensics when it comes to taking a look at these documents. The takeout financing on these buildings is usually in the millions of dollars. So, you're not talking about a few $100,000 refinance here. So the documentation that's required is usually decently extensive, and they want to just verify that the operating income is exactly what it is and the expenses are what we say it is. So
what's going on YouTube? It's Rebecca Lynn Matheson here, and welcome to another episode of the Findlay Finance Friday on the Canadian Real Estate Channel. Today we're going to be breaking down apartment takeout financing, the ins and outs of how to prepare once you have your apartment building and are wanting to pursue that takeout financing. So welcome to the channel, guys.
Thanks for having us again.
Absolutely. So let's break down what exactly is apartment takeout financing first, and also at what stage during the purchase are we looking to take out financing?
Sure. So I think it's important to preface the current climate that we're in. So when it comes to purchasing multifamily properties, the last 24 months have seen a drastic increase in value of these assets. Now for commercial financing, the actual takeout financing or bank financing is based off something called a debt servicing ratio or debt service coverage ratio. And that's based off of the income that's generated on the property. Now, asset values have increased, but income on properties have not increased as drastically as the asset value has. So the majority of investors right now are closing on these properties with private capital or some sort of creative financing solution to get in, whether that's cross-collateral or a private financier to come in and help you purchase the property. And once you have the property under contract, your whole mission is to reposition the property and then stabilize it at market rents. And that brings us to takeout financing. You have stabilized your rents. Now I got to get my private financing paid out into bank financing to be able to get your cash back and to be able to have that cash flow and rinse and repeat and do it again.
Yeah, so I think we just wanted to let everybody know what are the steps and what to be prepared for as you're going through the process. The whole process for a large, commercial type refinance right now is 6 to 8 weeks, but closer to that 8-week mark. There's a lot of equity takeouts being done right now. The lenders are, inundated. It is taking a little bit longer. Commercial deals on average take 6 weeks. So, make sure you prepare for probably about a 2-month process ahead of time. So, if you're in private financing and you're coming up on that end of term, have an idea of how long this is going to take. You definitely don't want to be stuck, running over and having to potentially pay any renewal fees. So, what are we going to be needing and what to prepare for? First things first, get together all your personal documentation, 2 years of taxes, your T1s, your NOAs. We're going to need 2 pieces of ID, financial statements or a personal net worth statement. Each lender is going to have their own specific documentation that they want signed and dated. Articles of incorporation if it's in a company. If the company's been around for a few years, 1 to 2 years of financial statements to show how that company's been operating. Income expense reports for the specific property, rent rolls, copies of leases or tenant acknowledgement forms, whatever they are and whatever we're going to require. And the personal or the debt servicing sheet for that property itself. So basically that's going to be something that Josh and myself would do. We're going to take a look at all the income expenses, figure out how it qualifies and what loan of value your property is going to be coming in at on that refinance, and getting all the documentation, the reports for the building itself. So taking a look at the reports and essentially some of the costs of them, most of these reports are going to be 2 to 3 weeks. So in that process and in terms of the timeline of everything, be prepared to allocate that 2 to 3 weeks for those reports. Standard cost for the reports, your environmental, your building condition, your appraisal, you're usually looking around like $1,600 to about $2,500 depending on how quickly you need it done and the size of the building. There's going to be some additional costs. You're going to have your legal fees. Legal fees can be anywhere from $2,000 to maybe $4,000 or $5,000, again depending on the size of the file and how big it is. There's going to be some broker lender fees. Broker fees are usually around, or we charge 1% on conventional apartment financing, and then the lender fee themselves usually 25 to 30 basis points. So overall, you're looking at about 1.3% in that fee area there. That kind of gives you a bit of a rough idea what the costs are going to be. There are some ongoing costs as well. Once you've gotten into conventional financing, you're going to have a $250 per year just admin general cost of managing the file, and then you're going to have your legal fees of preparing your financial statements for that lender. Could be $1,500 to $2,000 depending on how complicated the file is.
Yeah, I can see that this would take a lot more work than just a single family home. We're talking maybe, let's give an example of a 24-unit building. You're going to have to get together all of the lease agreements. You're going to have to account for all of the income, and if at this point you've put work into the property, I assume you're going to have all of the receipts from all of the work that you've done as well. So this is going to be quite a sizable impress the bank folder when we're going into this stage.
Yeah, and if you have this property, like if you have multiple people on the corporation, we're going to need all of this for everybody, and essentially anybody who is a majority shareholder. So if you have 15 to 20% ownership in the company or greater, they're going to ask for these documentations. And I'm going through a file right now where there's actually 5 different corporations on the corporation. Wow. So we need documentations for all the shareholders. We need financial statements for all the additional ones. So depending on how complex that ownership structure is, there can be quite a bit of documentation involved. So this is why we like to start it early. As we submit things in and it goes into the credit department, credit may ask for more documentations and come back to us. So it can be a bit of a back and forth process depending on what the credit department requires. So don't be frustrated with us if we're coming back and forth, and we like to give a big lump sum of documents ahead of time to try to cut out as much of that back and forth. But if the credit department is asking for more, we got to come back and ask for more. So
yeah, and I think it's understandable that it's kind of like forensics when it comes to taking a look at these documents. The takeout financing on these buildings is usually in the millions of dollars. So you're not talking about a few $100,000 refinance here. So the documentation that's required is usually decently extensive, and they want to just verify that the operating income is exactly what it is and the expenses are what we say it is. So whether that's verifying through a third party or taking a look at your pro forma when you had initially given it to us. Something to keep in mind is we probably have the majority of these documents already on file. When you're going to purchase one of these buildings, you're going to create a pro forma, and that pro forma is going to outline what the total market rent is going to be estimated based off of how many units you can turn over and when you stabilized it. So you're probably going to have these numbers already, or if you don't, we probably already sat down and did it together. But verifying these numbers and making sure all these things are correct is going to create like a successful transaction that isn't going to be bogged down with delays and going back and forth with lenders. Takeout financing for larger multifamily buildings it's really interesting because it's the same kind of in a sense, but it's also different than residential real estate, specifically because there isn't like a gestation period when it comes to being able to take out capital. So as soon as you're actually completed the project, you can start the process, or if you have timed it correctly, you can probably start the process about 2 or 3 weeks before all of your construction and stabilization is finished, set the appraisal up, and then have everything submitted to credit by the time you're roughly done your project. There isn't really a cap when it comes to the amount of capital you can take out or pull out. They are going to look at a handful of things, and it's a little bit different than residential in this aspect, specifically because they take a look at the operating income, but also yourself, and it's kind of a gray area because, how strong are you as a borrower? What are you using the funds for afterwards? If you don't have an exact use for it, they're going to want to know why you're pulling this much capital and what you're going to be doing with it. Right. What does your income look like? What does your credit look like? What do you do for a living? What is your net worth? All those things are factored in to a decision with credit, but not necessarily from a quantitative perspective as does that qualify for the loan. So the more solid of a package that we can get, the more effective we can be in regards to timeline and the max equity takeout that we can get on these buildings.
Yeah, that makes a lot of sense. So once we have the actual paperwork together, what are the next steps? What do I need to do as the owner or in that investment corp? What are the next steps in terms of getting that?
Sure. So once you have all of your paperwork together, meaning you have all your new leases signed, you have all your receipts already ready to go, we have all the documents to us, we would then order an appraisal and possibly a building condition report and possibly a phase one, depending on the size and location of the property itself. Each lender has their own parameters if they require these additional documents. Just depends on the lender you're looking to use. Once those are done, I think Erin said between 2 to 4 weeks in between there, depending on location. Once those are completed, then we submit it to the actual bank. Now, there's a process within the bank that there's a handful of people need to look at it, review documents, go through credit. So credit is the department where they take the entire package and they look at absolutely everything. And that's where they create like a risk profile for you. Like, does it make sense to be able to issue a new loan and take out this financing, this private financing that this person did? Credit can take anywhere between a week to like 3 weeks, and sometimes even longer if you're in like a really busy season. So understanding the time frame expectations as to how long that would take, we want to close your deal as fast as possible, and we understand that there are specific costs associated with carrying private loans. So having everything up front right away is imperative to being able to not have additional carrying costs or cost you more to increase your bottom line. Once credit is done, and they come back to us and say, look, the deal's approved, they're going to give you some options. And those options are going to outline fixed and variable terms. And then we're going to sit down and say, does this make sense for you? Do you want to lock in a 5-year fixed? Do you want a variable term that's going to give you more flexibility to break? And that's going to depend on if you've fully turned over your building or if you're just kind of refinancing to get out of that private loan that you're currently in. Because sometimes what we'll do is we'll have multiple transactions. So once you're in private, we'll get you just to the minimum requirement to be able to debt service, take it out so you have a lower carrying cost, and then your strategy after that is to either naturally turn over the tenants or to stabilize the building over a longer period of time. And that's going to allow you to be able to have a lower carrying cost and lower fees while you're in that final stage of repositioning the building. At that point, once the credit has given you an approval and we choose a rate and fee structure, it takes roughly about 5 to 7 days to issue paperwork, and at that point paperwork is signed and then the lawyers are involved. If you've closed a commercial transaction before, you're going to know that it takes a lot more time than a residential transaction. It's probably going to take about a week, possibly 2 weeks, depending on all the reports that they need to pull, all the checks they need to do. But once essentially it's at the lawyer's office, the banks work on trying to close that deal as fast as possible. And then essentially the funds that you're going to be getting from your refinance are going to pay out your current private loan, plus any additional above that is going to go into your bank account, and you're going to be able to be reimbursed for maybe your down payments. If it's a perfect BRRRR, all your renovation costs, fees associated with it, and closing costs if you've done your numbers correctly. But the process is decently straightforward. It's just extrapolated and takes a lot longer to be able to complete just because of the size and of the actual loan itself, as well as the process and how many people need to sign off on these loans.
Absolutely. Now guys, if you're enjoying this video, make sure that you give us some love and like and subscribe to the Canadian Real Estate channel and check out some more of these Findlay Finance Friday videos. But you mentioned, so now we're at the stage of getting the money and paying off that private loan that you originally closed on the property with. Are there any other considerations that the investors should take into account, or any other things that somebody who's trying to take back a mortgage should be aware of?
Yeah, so I think the first thing that maybe take a step back is taking a look at, are you using the correct numbers when you're putting together your pro forma to make sure your numbers are going to be accurate on that takeout financing. Each lender underwrites slightly different, but there are some generalized numbers that you can use when you're running your numbers just to make sure you're on par with what we're looking at. Things like property taxes, insurance, utilities, that's pretty straightforward, and it's going to be very property specific. You should get an expense report from the seller when you purchase that property, so you should have a good idea of what those fixed costs are going to be. The utilities might change throughout the course of turning over those leases. If you have leases where the tenants aren't responsible for anything and everything's all inclusive, and you're turning over those vacancies and they're going to be playing plus hydro or plus heating, whatever it's going to be, you can mitigate those utilities. But property taxes and insurance are going to stay roughly the same throughout the course of the transaction. Vacancy, we're using 3 to 5% on that mark. I know 5% seems high and people argue about it, but it's not up to us, it's up to the lenders and what they want to use and what that underwriter feels comfortable using. We can always make a case to use a lower vacancy, but I see a lot of people running vacancy at 1 to 2%. It's just not realistic for what a lender is going to be using. 3% maybe if we can make a good case for it, but there are lenders using 5% on vacancy for these apartment buildings. Management costs, again, 3 to 5%, and this is of the gross revenue number, so just so people understand. If you're self-managing and we can show a good history of management, maybe you own a management company through one of your holding companies or whatever that is, or you have a good portfolio and you manage it yourself, we can look at mitigating that down to a zero cost, but usually that cost is a 3 to 5% of gross revenue expense. Maintenance on the building, there's a couple different ways that we run this number. 5% is kind of on average for what we see. Sometimes it's a per door cost, so it could be $500 per door, again, depending on what lender we're working with and what they're using on their underwriting. And then sometimes there's a janitorial and garbage removal cost as well too, which some lenders use, some lenders don't use. The lenders that do use it, it's usually around $300 a door, so making sure they factor that in. If you have a large building that has a lot of mechanical systems, maybe elevators, stuff like that, you could have a 2% commercial structural fee, but for the most part we don't see this unless it's a bit of a retail building, or like I said, if it's a large 80 unit, you got 80 floors, you need elevators, stuff like that, they're going to want you to have some structural reserves in place. But you got a smaller 1-story type apartment building, you're not usually going to have this 2%, so that's usually something you can get away with. But just for people who understand they're trying to make those numbers work, these are the numbers that we're using. Like I said, using unrealistic numbers can definitely harm you moving forward. You think, okay, I just need a bare minimum income of $10,000 a month, but you're using 1% vacancy, 0% management, and you have zero history of managing, and all of a sudden you're using 5 and 5. Well, now you need $15,000 even budgeted for that. You're taking out at 65% instead of 75%. So there can be a drastic difference there. When we're taking a look at some terms that we generally use, gross revenue is obviously just your gross revenue as is. We can use laundry income. Ideally, we have some sort of financial statement from the seller that shows over time there's been laundry income used and added and stated on financial statements. Parking costs or garage rentals, if it's on a lease, we can use that for sure. If there's a history, again, through the financial statements that shows that, we can average that out over the years and add that back in. That all goes into your gross revenue. So your NOI, your net operating income, is your gross revenue minus your operating expenses. That gives you your net operating income. If you're looking to kind of put together a hypothetical valuation of where your property is going to come in at, you can take a look at using your net operating income and your cap rate and essentially dividing that net operating income by your cap rate, and that's going to give you a decent idea of where your property value is going to come in at. Now that cap rate is a bit of an opinion type number, depending on a few things. One, what market you're in, whether you're in GTA versus a secondary market like Chatham or Windsor. That cap rate is going to vary drastically sometimes. You could be 2 to 3% in Toronto, you could be 6.5% in Windsor. It's just based on market activity and where all the values are coming in at. So just making sure you talk to us and, hey, am I using the right cap rate? Again, if you're using a 3% cap for a property in Windsor, it doesn't make any sense, and you're probably not going to be anywhere close to what you're thinking you're going to get taken out at. And that increase in value may not be there enough for you to even take out that private mortgage. So it's important to utilize that properly. And then all in all, when we're looking at our final valuation of the property, like Josh said, we're looking at 1.2% is our ideal number, and we're getting that number by taking your net operating income and dividing that by your annual mortgage payment. So you'd have to understand, what are we looking at for underwriting? Commercial properties on the multifamily side, up to 25-year amortization max. We're not getting 30-year AMs unless we're going with CMHC insured financing, which is a completely other kind of conversation. Depending on where that economical life comes back at, you could be at 20-year AM, so that could reduce your financing. If you got an older building, 150 years old, it's pretty worn down, hasn't really been maintained through the years, you could be at 20 years and not 25, and again, that can, like I said, drastically change your numbers. In terms of the interest rate for Ontario, at least, we're running 3.69 to 3.85 depending on where it is. Is that going to be your actual contract rate? Maybe not. Could be a little bit lower depending on what type of rate and term you want to go with, or fixed versus a variable rate mortgage. But in terms of underwriting, that's the numbers that we're taking a look at. And again, that 1.2% DSCR, that is your ideal target. We can work with less, 1.15. If you're a really strong borrower, maybe the property still has more room to be turned over. You got a good personal net worth, a good history of getting these things done. We can work with that lower value. But, if you have a small net worth, you'll be making, a few $1,000s a year in income and you have no experience, you're probably not going to get away with that lower value. So 1.2 is ideal. 1.25 is great. We can do quite a bit with that 1.25. So really making sure we're dialing in that debt service ratio before we get into the financing. And the cool thing about commercial is that it's all reverse engineered. So, you get a property, it's got some vacancies, we can tell you what those rents have to be at for this to work on the takeout financing ahead of time. So you go into the project knowing I need $1,300 a lease to be able to make this work, versus if you need $2,200 a lease and you got 6 vacancies and they're bachelor apartments, you're probably not getting $2,200 for all 6. So, is it realistic? Do the numbers really work? And it's very easy to be able to reverse engineer that and let you know, are your expectations realistic, or do we need to kind of bring down to earth a little bit and revamp the numbers?
Yeah, I think that reverse engineering is actually a really important point that you've just made there, especially when we get market specific and talk about cap rates in different markets, like one cap rate in Hamilton or Toronto versus Chatham. It does vary based off of the independent market, and also rents do vary too. So you have to consider what market you're operating in, what the numbers are, and I really like the point about reverse engineering the rents and just considering what the upside would be, so that we can actually see, okay, how much per unit you need to get in rents in terms of actually qualifying for that, and really optimizing the returns from there. So yeah, definitely appreciate that point. And is there any other considerations, I guess, from the investor standpoint that we should be aware of?
Sure. When you're looking at commercial financing, I think that this is a very analytical thing to assess. So if you're an investor who is more hands-on, and you just want to do a bunch of renos and hopefully it works out and you force appreciate, but roll the dice, maybe it's going to be what I need it to be. That is the exact opposite of what this is. When you're looking at creating a strategy for a building, you can know with very close certainty what that ARV value is going to be. And as Ehren said, it's all about just reverse engineering. So the pro forma you're going to make is going to outline your total profit. You're going to be able to figure out how much capital do I actually need to put in per unit to be able to raise that income to market rent, to be able to get my total value and my refinance on the back end. It has everything to do with more numbers and less to do with just swinging a hammer. And it takes nothing away from people who go and do flips and stuff and on the residential side, but this is just very analytical focused when it comes to being able to figure out, like, does this project make sense? And commercial financing, when it comes to these multifamily buildings, it has the most lift that you could possibly have with a real estate investment at the moment. We're seeing a huge influx in people moving from the single family homes, duplexes, triplexes, into the commercial space. That's 5 units and up, specifically because, again, there's more money to be made in it. If you've done duplexes and triplexes, it's not very difficult to be able to scale to a 5 or 6 unit building. There is no true residential GDS TDS ratios for qualifying, and you can scale to an unlimited amount. So once you kind of crack that code and figure out the numbers on the back end, it's very easy to be able to repeat the process and continue doing this over and over again.
Absolutely. Now, you mentioned the specifics about how you qualify, and I'm sure that could be a whole nother video breaking down the exact qualifications for apartment buildings. I think it's very important to note that it is number driven, and that you are running this as a business. You have to reverse engineer the numbers. You have to understand what the end goal is in order to ensure that you're not over renovating the units, that you're actually planning everything accordingly in your project to ensure that you're hitting the space and creating the unit in a way that will allow you to get that high rent if that's what you need, or maybe you know that you only need a certain amount of rent to actually hit those numbers, so you can actually save a little bit in that renovation budget. So I really like that reverse engineering method, and from a business standpoint, it's so important that you know your numbers, especially if we're talking more than 5 units.
100%. Yeah, if you guys have any questions about commercial financing, if a building is going to make sense, acquisition financing, we have a ton of videos actually outlining how you go about qualifying for these types of products, what to look for when you're assessing a building. We're going to be dropping a new video outlining all the costs that you can expect on repositioning a building. We foresee the majority of investors moving into this space as you see the values of single family homes and smaller properties increasing. It's going to become more difficult for the average person to qualify conventionally for a property based off their income. So I think this specific space is going to grow exponentially, and understanding how the underwriting works, understanding the process and how to do this is going to set you guys up for the most success in the future.
All right, guys, thanks for tuning in for another episode of the Findlay Finance Friday. Again, if you guys liked today's video, make sure you give us some love and feed the algorithm by smashing that like button, and subscribe to the Canadian Real Estate channel for more amazing real estate investing focused content where you can learn how to grow, build, and get started with your real estate investing journey. If you guys want to learn more about financing, make sure you tune into these Finance Friday videos. As well, check out the Findlay Team YouTube channel. They actually break down all sorts of different ways, as Josh mentioned, as to how you can get financing for different types of projects, including apartment buildings, and they're going to be breaking down the numbers and costs associated with doing so. So thanks again for tuning in, guys, and we'll see you on the next one. Peace.